So we talk with folks every week about the home buying process, and it sounds like there are a lot of myths kind of surrounding the pre-approval process. Do I need this gigantic down payment? Do I need the perfect credit score? What are all of these things that are, nebulous and this giant cloud that is around the pre-approval process? So we've got Bethany here to talk us through some of these things and going to help us bust some of these myths and get through this. So thank you, Bethany, for joining us. Let's get through this.
Ooh, thank you. I'm excited to be here and chat about this. I do think, I know you hear it a lot when you're talking to people that are looking to, buy in the area, move to the area and buy. And they think, I think the big one, and you briefly touched on it, is that you have to have 20% down in order to purchase a home. I'm just going to jump right into it, obviously. So basically, you don't have to have the 20%. That does allow, if you do have 20% for a down payment, what that does is it allows you to purchase a home with a conventional loan without paying mortgage insurance. So it's great if you have that and you choose to use your 20% down for that. However, even if you want to utilize the conventional loan, you can still go as low as 3, maybe 5% is their minimum. 3% is a product you have to qualify for. And so there's income restrictions or first-time home buyer restrictions on that. But 5% is the minimum, or you could utilize some government products like FHA. That's only 3.5% down. And then if you qualify, if you served in the military, you could use the VA loan. That's 0% down. And then also we have another program that's a government-backed program that's another 0% down. They don't have to be a veteran for. And a lot of the area, specifically most of North Pole and a large portion of Fairbanks, does qualify for what's called a USDA Rural Development Loan. And that is also 0% down.
Yeah, those are fantastic packages, and not a lot of folks, especially with the USDA program, not a lot of folks know about that one. So they're like, well, guess we can't do it because I don't have this 20% down. And it's not the case. There are a lot of programs that are out there to help people get into homes, and we can be doing it. And another one of those things that people think that they need to have is this perfect credit score to get into a mortgage. And can you talk a little bit about that?
That's another good one. So credit score, you don't have to have perfect credit. Yes, having great credit is something that we, just as consumers, want to be cognizant of because it opens more doors for you. And you have the option, having a really great credit score of like 740 or above allows you to have the option of a better interest rate when you are trying to, essentially take on more debt to your financial picture. But it's not a definite no. For like those government loans, those are the ones that really allow for, what they've done is they've really tried, FHA in particular, they've really tried to open the door for more people to be able to buy and have home ownership as a possibility for them. So a lot of lenders, including myself, can go as low as 580. Your credit score could potentially be as low as 580 on those. Same with FHA. And a little bit lower even on that USDA one as well. We want to see a little bit higher credit score on that one, just because it's just classified as a higher risk with that 0% down. But yeah, it's definitely a possibility for a lot of people.
That's awesome. So I think that's another thing. A lot of people are thinking that they need to be in this perfect credit situation in order to get to a home.
Yeah. Another one on credit is a lot of people think that, I have a lot of bad medical debt. Like I've got medical collections that I haven't paid. I know I'm not going to get approved. And that's not true. Your medical collections have already impacted your credit score. But what I don't have to do is count those medical debts against you. I don't have to include that in your debt to income ratio. It's one of the factors of getting pre-approved. So that's a nice one too. They've eliminated that.
We should include that in kind of our sixth myth that, if we're going to get pre-approved for a loan, we should kind of wait until we are, looking at homes tomorrow to get pre-approved. We should probably have that conversation well in advance so that way we don't have to, find out about things later.
I know there's something about people have this idea of, and sometimes it's just like for pride, right? So people who have a really great credit score definitely they understand a little bit more. They've done their research, right? Maybe they've been in the game before. And so they've heard some things, on the streets or wherever, that you don't want your credit pulled a lot. It is true that when you check your credit, when you have a hard inquiry on your credit, it is a little bit of a ding on your credit score. However, it's not huge. It's not going to be, it changes. It's not like a set amount. Like, it's not like every time it's going to be 10 points. But for every person, it's a little bit different. And if you haven't had your credit checked in a long time, you're going to be fine. It's not going to make or break your approval. And so I can't tell you how many times there have been things that have been on people's credit report that they had no idea was on there. Sometimes it's a mistake, and they can get that removed really quickly, or just things that we could do knowing what your credit score is, and you can just get a game plan of what your credit score looks like, and it doesn't cost you anything to have your credit checked, right? So it's always a better idea to plan ahead of time, just see what's on there, see if there's a random late payment. I've had somebody who I've done loans for many times, great credit. And one time we went to buy a home, and all of a sudden there was a random late payment on his credit card that was a mistake from the credit card company, and it tanked his score over 100 points. And then we had to wait to get that. It didn't take too terribly long, but we were able to get it fixed for him. So it's important to check ahead of time.
It's super important. It's just like talking with kids about grades. No one's going to care more about your grades than you will, and no one's going to care more about your credit than you will. So if you are thinking that you might be looking to buy in the future, taking a look at your credit and seeing where it's at today, and maybe rectifying possible problems on it today can help you out in the future. Because if you find out that your teacher didn't grade the back half of your assignment, and now you got to go argue your grades with your teacher, knowing that before your grades come out at the end of the semester is really important.
Yeah, exactly. Don't let your pride get in the way of not being able to buy a home for your family when you get here. Yeah.
Speaking of numbers, I was going to go into either interest rates being the most important factor, or fixed rate versus adjustable rates.
So interest rates play a big portion of what your payment is, but I wouldn't say it's the biggest piece. The biggest piece is, the reason I say it's not the biggest piece is because everybody's got different reasons for purchasing a home, and the interest rate is something that you don't have control over. You have control over what your credit score, and that's the piece that you can control of how it affects your interest rates. But there's so many pieces that affect what the interest rate is that you don't have control over. You don't have control over what the economy is doing, what inflation is doing, what the 10-year treasury is doing, what jobs are, what are there a lot of jobs out there? It basically boils down to the economy, but those are the things that you don't have control over. So it does play a big piece of what your monthly payment is, and it is factored in. However, I just say, if you need to purchase a home for you and your family, if you're relocating to the area, or if your family dynamic has changed and you need a bigger house or a different house or smaller house in a different location, then you just need to work with a professional that can help you navigate and move around all the financial pieces of your picture in order to make home ownership obtainable. And I think historically, one of the biggest ways that we can generate wealth, and even just for ourselves and our generations to come, is through home ownership. Houses typically appreciate over time, right? Very, very few times in our history have we seen housing prices decline. And so if you can, purchasing a home is most always a great option for you.
Yeah, absolutely. And one of the things that I talk about all the time is like it's a lot like trying to see Superman and Clark Kent in the same room at the same time. You're not going to see low interest rates and real estate prices in the same room at the same time. right now interest rates might be super high, but our real estate prices are dropping lower and lower every week. So, we're now is the time to be buying because the prices are never going to get lower.
Yeah.
They're only going to get up. I mean, if we see a drop to 5% on interest rates, it's going to be crazy.
Exactly. I mean, we saw that during COVID, right? I mean, do you remember when toilet paper was like a commodity? You couldn't find it anywhere. And so people were hoarding it. And so they, you paid $5 for a roll of toilet paper. And so the demand was low, the demand was high, the supply was low. And we're seeing the same thing where the supply is still low. So when right now interest rates are high, but it has made the market teeter into more of a buyer's market, which, correct me if I'm wrong, I don't think we've had a buyer's market in about 10 years, right?
Yeah.
So now you have the ability to negotiate, not pay over asking price, right? I see seller credits all the time on pretty much all of the contracts that we're receiving. And it's very, very common, maxing out the seller credits because people who do need to move out of the area have to sell their home. We have a very transient community with the military and things like that. There's movement a lot. And so people do have to sell. And if you wait until next year, if and when the rates dip back down into the fives, you're going to have that same, everything's off the shelf. You're going to pay $10 for a roll of toilet paper when you could have paid 12 months ago.
Yeah, I mean, and we're obviously speaking a little bit metaphorically, the toilet paper, but the analogy is the same. Like during that same time that we were spending all that money for toilet paper, prices in Fairbanks for real estate went through the roof.
Yeah.
People were lining up and competing like crazy for for homes just the same.
I mean, the most I saw, I think, was 75 in our market, was 75,000 over appraised value.
Right.
So somebody was willing to pay 75,000 over appraised value. I haven't even done the math, but I don't even know how long you would have had to have been in that home for that to make sense. Right. And the change in your, the difference in the monthly payment, all those kinds of things. If you really think about it, the difference in your monthly payment right now, if you have the versus like what you could refinance, right? If you buy a home now, let's just say you get locked in at like a 7.25% versus, which is about right, that's about average right now. Which it used to be higher just about 2 months ago. So that's the other good thing is interest rates have dipped. So they're about the same as what they were in mid-September. Because those numbers have started to come down because the feds have started to taper off of their rate hikes, which is really great for mortgage rates. However, the difference in that monthly payment of that 7.25 versus maybe like a 6.25 or a 5.25 would equate to maybe, depending on your purchase price, like let's just say $140, right? If you pay $140 more each month, and then in 12 months, you go to refinance your home, you would have paid an additional $1,600, $1,700 in that 1 year of that difference, that monthly payment. You can refinance. Refinancing basically mostly is just title fees. So maybe you're looking at like $5,000 or $6,000 in a refinance. It's still not going to run you $10,000, $20,000 over appraised value when you are competing.
Yeah, I mean, it's a lot of it just doesn't make sense to do.
Yeah, it's just kind of that mindset, is this an opportunity or is this an obstacle right now?
Yeah, that's why I'm happy we're talking about these myths and just knocking them down.
Yeah.
While we're on the topic of interest rates, there's another myth that fixed rate mortgages are always the best choice. Are fixed rates better? Always the best choice over an adjustable rate. What do you think?
It's again, it's person to person. It really depends. And one of the myths I think of of adjustable rate mortgages is that it could adjust at any point in time, right? Adjustable rate mortgages are fixed for a period of time, So depending on how long you plan on being in that home or in that mortgage, I think the national average is about 7 years, what they typically say. You're in that home or that mortgage for about 7 years, right? Because you can always refinance. Almost everybody refinanced during COVID because the interest rates were so low. Or you need, we talked about generating that wealth, and that equity that you gain in your home because of the home appreciation. A lot of people opt to do a cash out refi in order to tap into that equity to, make improvements or send a child to college, or maybe something happened and they have to pay a ton of medical bills, like those kind of things that do come up. So you eventually are typically refinanced within 7 years of having that mortgage. Those adjustable rate mortgages are typically like a 5 year. So it's fixed for 5 years, 7 years, 10 years. Those are typically what are offered. And so as long as you refinance those mortgages within that time frame, you are a fixed rate mortgage. And then there's caps on how high it can increase from there. If something happens and you can't refinance or sell a home or something like that in that time frame, but it is fixed for a period of time. So sometimes you can get a better interest rate with an adjustable rate mortgage. Not always, but it's an important conversation to have and to make sure that you analyze all of the options available to you. When you talk to your mortgage advisor, that's what they're going over with you, or all your options, that you are going to know your situation, your financial situation the best. And so it's important to just know all of your options so you can make the best decision for you and your family.
I think just as you were talking about, I think that there's a lot of folks that think with an adjustable rate mortgage that they're going to get a letter in the mail saying, "Oh, next month, your interest rate's going to be 15%. Yeah. So your monthly payment's going to be $14,000 more." And that's just not the case. That they are fixed for a period, and that there's plenty of notice when you do have a rate.
When you get your mortgage, when it's going to adjust. And then you should also know your lender should also be able to go over with you what the caps are, so you can plan accordingly.
Yeah, it's not just this nebulous thing that's out of nowhere. It's twice I've used that word.
I see that.
And then where pre-qual means that you're guaranteed for a loan. Next on our list of big myths that we need to bust and knock down, that just because you get a pre-qualification letter means that you are guaranteed for a loan. This is one that we get quite a bit, especially with folks that are going to be PCSing into Fairbanks, and they've had a phone conversation with a national lender, and they're like, "I'm pre-qualified. I've got this piece of paper for $400,000, and I'm ready to buy." So it's just not the same thing.
It's not the same thing. So there's two terms. There's a pre-qualification. That's the way that that's basically like, you telling the IRS, I made, I don't know what the good analogy is, but you tell the IRS whatever your income is, but you need documentation to back it up, and just hope that they never come back after you. I don't know if that's a great analogy or not, but a pre-qualification is mostly like what they used to do back before the housing crash of 2008, when there was a bunch of stated income loans. Basically, if you could fog up a mirror, you got a loan for a home. That's not anymore. There's documentation that has to be had. So there's so many federal rules that were put into place to avoid that big housing crash again. And so we're not seeing, which is great, we're not seeing the predatory lending. We're not seeing the stated income loans. Mr. Joe is a janitor at the school and claims that he makes $1 million a year. That's not true. Now we have to have W-2s, pay stubs to back that up. So if your lender is not asking for those up front, then I would be a little leery, just because it's a requirement of your loan type. It's not lender to lender. There are some programs out there that you can get stuff online, like your lender can pull some of your employment information online. So that might be what they're doing, but it's important to ask the questions, because you want to be protected as a consumer. You don't want to find out and have everything, you've put earnest money up, you've made plans to move your family into this home, and then the day before closing, your lender calls you and tells you that you no longer qualify. And I see that quite often, you know, where I get a call from a realtor in town that says, hey, this person was using an online lender and everything was good to go. We had that pre-approval letter, and now we're a week out from closing and they're saying they no longer qualify and they just cancel their loan. And so we do try to help them and figure out a way to make it happen for them. But that's why it's important to work with somebody, a trusted lender.
Yeah, I mean, in those kind of situations, their phone call is, hey, sorry, we went and ran your credit one more time and you don't qualify. So, good luck. And that's it. Like there's nothing going forward from there. They don't say they don't have anything more. That's just it. So they expect the buyer to kind of figure it out. Like they're not going to help out. Like there's no, here's money, here's your earnest money, because at that point in that transaction, if the buyer can't follow through with that transaction, they lose their earnest money. So if they've got, $2,000 to 2% of the purchase price of earnest money on that transaction, then they could be losing to $2,000 to 2% of the purchase price of skin in the game on that transaction. And that's a big deal.
Mm-hmm. It's a huge deal.
Yeah.
On top of losing the house that you thought you were going to move your family into.
Yeah. So that's thousands of dollars out of pocket. That's, potential for 30 to 60 days of possibly looking at being, on post, on base, in a hotel somewhere, trying to find a rental. It's a painful situation just because, we decided to work with a lender that was kind of out of town and doesn't really know how things work.
Doesn't do their due diligence up front. Exactly. A lot of times they kind of bait that super low interest rate, if they're baiting out like a 6.25 and saying that everything's fine, I don't need any documentation. I'm not saying this happens all the time, but just ask questions and talk to your realtor and make sure that they know who that person is. They've worked with them before. They have a history of closing loans and closing on time, and so if they have a good track record, then they're probably somebody you can trust.
All right, so we busted a lot of good pre-approval myths here, and we've got a good plan moving forward. Bethany, thank you so much for joining us again. It's always a pleasure having you here to talk with us about some more and awesome lending information, because I don't know everything and you know so much more than I do. So I really appreciate your time. Thank you again.
I love when I get to be here too.
Good. I'm going to drop your information here in the description below. So if anyone ever has a question for me, my information is always there. My number is 907-885-0316. You can reach me there, and Bethany's information is down in the description. So thanks again for watching. Have a great week.